Everyone see what we are sharing. From Ibbetson's book. Ibbetson was a professor at the University of Chicago, and he started a consulting firm, and he publishes a book every year. And this is from his 2002 book, a page of it, because the data is quite interesting and has something that would make us think. This data is selected realized returns from 1926 to 2001. And he talks about a small company stocks, and he calculates average return. So he's taking yearly return, and we have a few different types of returns that CFA wants us to learn, and we discussed that last time. But here you could simply say, hey, we put 100 into all these small company stocks, and it became 117.3. And you get these individual returns for each year, and you average them over these years. So average return is quite easy for you and I. Large company stocks had 12.7%. LT for long-term corporate bonds had 6.1% return. So if we lend our money by purchasing bonds of US corporations, and these bonds were, for example, 10-year bonds, we would have on average 6.1%. Long-term government bonds made 5.7% in 2002, and US Treasury bills, which is short-term, less than a year bonds of US government, made us 3.9%. So this is an idea of return. And we assume that us investors, we are greedy. More return is better than less return. We like more money, right? So if they ask us just basis of return, which one of these investments are better, you would say a small company stocks, because they give us 17.3%, and that, for example, is more than 12.7%. But we all know that the small firms are more risky, and we may lose our initial investment. So we want to make risk measurable, put a number on it. The first attempts on making risk measurable was calculating a standard deviation. And for a standard deviation calculation, a very quick review from your statistics would say, let's say I'm talking to my grandmother, and there is an investor that can make her 1 million or 2 million or 3 million, and those are the three possibilities. And if I was the first statistician that wanted to talk about risk, I would say, well, on average, grandma, you would make 2 million. However, this could be different from 2 million. It could be 1 million less or 1 million more. Trying to put this idea of volatility into numbers, we calculate deviation from average. So the first investment made us 1 million, and the average is 2 million. So xi minus x bar, or deviation of average, is minus 1 million. This investment makes us 1 million less than average. The second investment possibility in the future makes us the average, so deviation from average under column xi minus x bar is 0. And finally, the last possibility in this classroom exercise is making 3 million, which is 1 million more than average. So if we add up these deviations from average and divide them by the number of the data, we would get 0. And obviously the reason that we are getting 0 is that minus 1 million and that plus 1 million cancel each other. Of course, if you were the first statistician that is doing this, you could take absolute values, saying don't write minus 1, write 1, and then this minus 1 and 1 do not cancel each other. It turns out that computers take more computation time with absolute values, and absolute values are harder for proving results and theorems in mathematics. It's much easier to cheat in the following way, and I say that lovingly. We would square these deviations from average. You and I know that if we square things, they all become positive. So in this simple-minded example, minus 1 million becomes 1 million, and the units, this is interesting, becomes dollar squared. That's why I kept the units. And when you add up these deviations from mean, or squared deviations from mean, something that later on in regression and everywhere else we look at, you would get 2. Now, to calculate this variance, which comes from the word variability, or how data changes, we'll say, well, these 3 numbers change by 2 units from, I should say 2 units a square actually, from the average. But we want to see how one of them on average changes. So we average these 2, or we divide this 2 by 3. For a technical reason, when we have a sample, we divide by n minus 1. That technical reason is that in linear algebra, when we estimate something, here we estimated the average from a sample, we lose 1 degree of freedom. We lose 1 data. 1 data gets fixed. So dividing 2 by n minus 1 or 3 minus 1, we get a variance of 1. Now, if they ask you what's the units of variance, which may come in a CFA exam, you say it's dollar squared. If I go out of this classroom and I talk about dollar squared, people would laugh at me. So we take a square root of this thing. We also blow up all these numbers by squaring them. When we take the square root of this variance, we call it a standard deviation. A standard meaning that we're going to have a standard unit, and then it would be 1. That's why I chose this problem. And a square root of 1 is 1, and then the units would be dollar. So units of a standard deviation is the same as the units of data, and it talks about how much the data varies from the average. So coming back to the good Professor Ibbotson and looking at his measures of risk, he's attempting to report to us how risky these various investments were. The small company stocks had 33.2% standard deviation. By the way, percentage is also a unit. So when you go to variance, this would be percentage square or out of 10,000. But for a standard deviation, we would have the same unit as the data. And now we know how the good professor calculated these standard deviations, just like the slide you saw. Calculate the average, which is 17.3, and look at each number, how it differs from average over those many years on an Excel sheet, and you could simply calculate a standard deviation. Okay, this standard deviation has certain properties. If it's 0, it means the numbers are the same. If our numbers in my last example were all 2, 2 minus 2 would be 0, and then adding these zeros, I would get 0 variance. The larger this standard deviation gets, the more the data varies from average, the more volatility we have, the more risk we have. And what does it mean that the standard deviation is negative? It means I don't know what I'm talking about. Because we squared these numbers, they're going to be all positive, and we took a square root of them. So looking at this investment, which is shown by average return, and its risk is shown by a standard deviation. We have 2 criteria for choosing the best investment. Imagine you have 2 criteria for choosing a boyfriend or a girlfriend. Here we have 2 criteria. One criteria is the average return should be the highest. So that 17.3% is the choice, the best investment. Invest in a small company stocks. The other criteria is a standard deviation should be the lowest. This is also an assumption. We later on call it risk aversion assumption. We are assuming that investors have aversion to risk and therefore demand a risk premium. They demand extra pay, extra return to shoulder risk. We are not always risk averse. For example, some people tie a cord to their ankle and jump from a bridge, and that gives them a rush, and they pay for it. So we are paying to take a risk, means we are not risk averse in that area. And there is quite a bit of discussion when we are risk averse and when we are not. Some of us gamble with gambles that require €1 payment to do a lottery, and it gives you a tiny chance at winning $1 million. But we gladly give that €1 when we know the expected value of this game is far less than €1, and casino always wins. So in some areas in life, we are risk loving. If we were risk neutral, it meant that the riskiness of these investments don't matter to us. But generally, investors, when it comes to buying stocks and bonds, tend to be risk averse. Okay, if we have this criteria, the best investment based on risk or having lowest risk here is U.S. Treasury bills 3.2. However, we want a compromise between risk and return. Is the risk justified by the amount of return we are shouldering? Is the risk that we are shouldering justified by the amount of return that we get? And of course, that would get us to this CAPM, starts the discussion there. But here in this slide, we can talk about this concept of an investment dominating another investment. That would be an investment that gives us more return for less risk. Can anyone identify an investment here that dominates another investment? Is there one that we should throw in the garbage because it's no good? When we look at another investment, it will pay us more and it will give us less risk. That goes to people on the internet, anyone who wants to talk, and people in the class. Is there an investment that dominates the other one and gives us a higher return than the other investment and lower risk than the other investment? Somebody is talking, all right? Go ahead.
Because I believe that long-term corporate bonds will dominate the long-term government bonds because they have higher...
But don't tell U.S. government. So the U.S. corporations, and of course this is for that period of 1926 to 2001, they paid more return, 6.1, which is more than the government that paid 5.7, but they had less risk. The risk measured by a standard deviation was 8.6, but long-term government bonds had a risk of 9.4. This data is real, and that's why I used it to make this point that sometimes this domination happens, but it doesn't happen with all 5 categories of investments, so we have to use CAPM and do more. So let's go to the next slide, and of course this is the formula for variance and standard deviation, and once you think about it the way I did in the last slide, this is a very easy formula to use. Some terms that CFA uses: gross return. Anytime you see the word gross or net in accounting or finance, you know that they are subtracting something. CFA uses net return for subtracting management fees. Usually we give our money to a money manager, and that firm takes a big chunk of our profit. Sometime in finance we say management is an off-balance sheet liability. That's our way of swearing at them. But they take a fee, and that eats into the amount of money that you get. So gross return that CFA talks about is your return before management fees, and net return is actually what you get after management takes some of your return for their services. Then we have after tax return. Of course, you and I in accounting call this gross and net return too. This was net of taxation. And so people ask you how much money you make, and you say 100 gross, but government takes 20, so I make 80 net or after taxes. Then we have the concept of real return. Real and nominal is something that often comes up in our business studies. Real means that we adjusted these returns for inflation. Usually we compound by inflation. And nominal is the coded rate. Then we have another concept that is called leverage return. This has to do with the fact that you and I can borrow money and buy stocks, often from our own broker. And very soon I'll do an example of that. When we borrow money and buy stocks, we get more return because we can cut our initial investment by half, borrowing half the money, and then this would divide the profit that we make by a smaller number, and we get more return. But it would increase the risk of investment, and we calculate that later on too. Here is later on a problem direct from CFA old exams. It says an investor buys 500 shares of a stock at $35 with 50% margin. 50% margin means half of it we paid and half of it we borrowed from the broker. After 1 year, the shares are sold for $50. So we have $15 of profit. The investor is subject to 15% tax on gains, and inflation over the year was 4%. Ignoring interest and commissions, the investor's real after-tax leverage return is how much? And the calculation is quite simple here. We say leverage return is we made $50 and we paid, the stock was 35, so the stock appreciated by $15. So we made $15 on this stock, but we didn't pay 35 for it. We paid half of it. So 35 times half is our initial investment. We divide by that, and we get 0.857, multiplying it by 100, we write it as 85.7% leverage return. It's quite high. Then they say do this after tax return. A formula to learn both in accounting and finance and everywhere in CFA is when they say after tax, multiplied by 1 minus tax rate. So this 85.7% simply gets multiplied by 1 minus 15% tax rate, or government gets 15% of it and we keep 85% of 85.7, and that is 72.8% after tax return for this investor. Then they want us to calculate real after tax return. Now we have to compound or discount by inflation. In this case, we are discounting by inflation rate of 4%. So we are making 72.8%. We got to write it as a 1 plus interest because we are writing our return. So 1 plus interest would be 1.728, and dividing it by 1 plus inflation rate, which would be 1.04. And of course, that one is to get your money back, and 7.28% is extra money that you make. So 1.728 divided by 1.04 gives us the return that we make, which would be which would have an extra 1 because we added a 1 to each of these calculations. We subtract the 1 and we get 0.66. and multiply by 100, you get 66%. Now let's go back to statistics and sort of look at a return that is in future. So far, what good Professor Ibbotson gave us was past returns. And for these past returns, we could calculate a standard deviation from the data and use it as a proxy or a measure of risk. But for future returns, we can't do that because we don't have the data. So here we are getting the use of statistics, and we're asking an expert to give us expert opinions about probability and scenarios that can happen. So here in this classroom exercise, which I took from Brigham and Houston, we are dividing the possibilities in future into 5 categories: recession in the economy, below average, average, above average economy, and a booming business environment. And we are sort of considering a one-factor model. Only the business environment matters. And the expert give us the following probabilities. Recession has a probability of 0.1. Below average economy has a probability of 0.2. Average economy has a probability of 0.4. Above average business environment has a probability of 0.2. And a booming economy has a probability of 0.1. Notice that these probabilities add to 1, and 1 is all possibilities, and of course 0 means that event has no chance. Then we are considering 5 different investments in this classroom exercise. It says we buy a treasury bill, and no matter what, it gives us 8%, no matter what happens to the business environment. So this is our safe asset, and here we expect 8% from it. Then we have an investment in a business that in this exercise they call high times. This could be jewelry business, for example, and we have high margins. So if a recession hits, people cut this high margin, expensive luxury item first, and we lose 22% of our investment. In a below average economy, we lose 2%, average 20%, above average 35%, and booming economy 50%. Again, notice that these numbers are subject to judgment, and of course, if you and I could perfectly figure out what investments pay in the future, we would be multimillionaire betting on them, and we wouldn't be sitting here. But this is one way that we analyze what happens to these investments, taking aid from statistics and attacking the problem. Then we have a collection agency. This is a counter-cyclical business. Collection agency collects bad debt. So when the economy is in a recession, quite a few people have difficulty paying, and this agency, which is a number of attorneys, and they write a nasty letter and charge, I don't know, 120 euros and send us the bill, have a lot of business, and they make 28%. In a below average economy, they are still doing well, thank you, they make 14.6%. In an average economy, they break even, they make nothing. In above average economy, we expect them to lose 10% of their investment in that firm. And in a booming economy, they would lose 20%. Then take an unrelated business, for example, is in Russia. In recession here, that business makes 10%, has nothing to do with us. In below average, it makes minus 10, average 7. So the movements are quite erratic. In above average, 45, and booming 30%. And then we have the market portfolio. We put all our money on DAX or trade on DAX. In a recession, we lose 13%, below average 1%, average we make 15%, above average 29%, and booming economy 43%. Then we calculate expected return. This is the part that CFA needs the statistics and reviews these very elementary concepts for us. For expected return, we multiply the probability by the payoff and we add them up. So in this case, I'll do it just for fun for high times, and you can do it for the other ones. High times pays minus 22 with probability 0.1 plus minus 2% with probability of 0.2 plus 20% with probability 0.4 plus 35% with probability 0.2 plus 50% with probability 0.1. I go back a slide so you quickly can look at high times and see that you are multiplying this minus 22 by 0.1, minus 2 by 0.2, 20 by 0.4, 35 by 0.2, and 50 by 0.1. So we get an expected return. This is, of course, a statistical way of saying the central tendency of this random variable is 17.4. In more classroom easy language, we can say we can expect to make 17.4% on this investment, but we might get disappointed. We might make less, or we might be lucky and make more. So this is a sort of average, talking about expectation of a random number. So we continue and calculate the same way all the expected returns or averages. Market has 15%, investment in Russia has 13.8%, Treasury bills has 8%, and collection agency has 1.7%. And of course, this is a very easy exercise you can do yourself to double check these numbers. Now, if they ask us which investment is better, again, that principle of more is better than less when it comes to money comes in, and we say high times that on average makes 17.4% is the best investment. High times has the highest expected return and appears to be the best investment alternative, but is it really? It comes back to the risk again. We got to consider the risk. So let's consider the risk. The same concept of a standard deviation comes again, except now we are doing calculations based on probability of events in the future. So what we do is we calculate the deviation from average squared, and I did it for the easiest one, which is Treasury bills. Average expected return was 8%, and the numbers were all 8%. So it's 8 minus 8 squared multiplied by first probability 0.1 and continued. And this raised to power half, or taking a square root of it, would give us the standard deviation. And of course, when it's squared, we get variance. And of course, 8 minus 8 is always 0. And the standard deviation of Treasury bills comes 0. And if you do the same calculations for other investments, you get a quick review of your statistics for CFA purposes, and you would get the following standard deviation. Treasury bills have a standard deviation of 0, and this is based on probability, and it's our way of dealing with uncertainty of the future. High times would have a standard deviation of 20, collection 13.4, and the Russian investment 13.8, and the market 15.3. It says what is the best return and the worst return? Same as before, the best return is 17.4%, the highest amount that we can make, and the worst return is collection 1.7. And there is a reason for having collection as the worst, because soon we're going to go to portfolio theory and say this is not really the worst. And our measure of risk, which is a standard deviation, is not quite adequate. What is the best risk and the worst risk? And the best risk is a risk of 0 for Treasury bills. Sigma cannot go negative. And the worst risk is high times with a risk of 20%. If we go back to the same stat class, one way to compare and look at the relationship between risk and return is to calculate a standard deviation divided by mean. The standard deviation talks about the riskiness of a venture. When we divide it by the average return, we are talking about risk per dollar that we make. Let's think about it brutally the following way. Someone goes to the ocean to fish and that person doesn't come back. What's the risk per dollar that this fisherman or fishing person makes? So we are looking at the risk per dollar return. And obviously, when this coefficient of variation is smaller, then this is a good investment. It makes us more return, and we are bearing less risk on our shoulder per dollar or per euro that we make. Okay, since we know coefficient of variation and it's just a matter of dividing risk by return, and we have risks and returns, let's do it. For treasury bill, the coefficient of variation comes 0. For high times comes 1.149. Collection agency is 7.88. The Russian investment is 1.3, and the stock market is 1.020. So based on this coefficient of variation, we would say the best investment is to loan your money to US government, but not every investor can, in a functional economy, loan their money to the government. To do business, we have to venture out there, and that requires shouldering risk. So if we look at the ventures, then actually the stock market as a whole, like putting our money in DAX or the stock market of US, has a 1.02 coefficient of variation. Here comes as a good investment. And the worst investment is collection agency. It gives you 7.88 units of risk per dollar that you make. But very soon we'll see that collection agency is not really that bad, and this has to do with our measure of risk that makes it look this bad. Collection has the highest degree of risk per unit of return. High times, despite having the highest standard deviation of returns, has a relatively average coefficient of variation. Okay, then walk in Harry Markowitz. He was his PhD dissertation at the University of Chicago, and he looked for a way of relating risk and return together in a formula, finding a compromise between the two. Actually, that PhD dissertation sat there sort of forgotten until later Sharp and Linter, two other professors, put this CAP-M formula, which you saw in my last lecture too, together. And these three individuals won the Nobel Prize for it because it is highly useful, not because it's rocket science. It's very easy formula with a very easy justification that we'll talk about it today again, and we talked about it last time. Okay, let's get there. Walk in Harry Markowitz as in theater, and he says, don't put all your eggs in one basket. That old saying, so if I fall, one basket of eggs breaks and the other one still has eggs. So applying this to these investments that we have in our classroom exercise, let's put half of our money into this high times and half of our money in collection agency, half and half. And let's see what happens. In fact, the name portfolio theory comes, portfolio is a folder that you put papers in, and here we are putting the stock certificates in it. So it says don't have one stock certificate, but have several of them in the folder or in the portfolio. All right, if we are doing the problem with two stocks, our expected return becomes the weight of the portfolio. Here our weights are half and half. Of course, we can do 10% in one stock and 90% in the other one. And the expected return of this high times is 17.4. So half of 17.4 plus half of 1.7, which is the expected return of the collection agency, would give us basically a weighted average of 9.6% as our expected future return. No surprise there. The surprise has to do with the risk. Harry Markowitz says one way of understanding what he's doing is to go back to these scenarios that we had, 5 scenarios with 5 probabilities, and we have the returns of high times and the returns of collection listed there. With probability 0.1, half of our money would lose 22%. Half of 22 is minus 11. And half of our money makes 28%. Half of 28 is 14. 14 minus 11 is 3%. Second row. In a below average economy, half of our money loses 2, minus 2. Half of minus 2 is 1. And the other half makes 14.7. Half of 14.7 is 7.35. We round it to 7.4. 7.4 minus 1 is 6.4 as portfolio return. In an average economy, high times makes 20. Half of our money makes half of 20, which is 10, plus half of 0, which is 0, and that's 10%. In above average economy, half of 35 plus half of minus 10 is 12.5. And in a booming economy, half of 50 plus half of minus 20 is 15%. Now, if you look at the column that says portfolio, all these numbers are positive. We put 2 investments that they can lose money for us, and magic happens. Now, magically, everything is making money for us. We got a safe investment that always makes money. In fact, Fisher Black has some essentially formula for making a risk-free asset from risky assets, which is the same concept that we are dealing with very elementary here. If we calculate the expected return for this portfolio, our formula was take the return and multiply it by its probability. So 3% times 0.1 plus 6.4% times 0.2 plus 10% times 0.4 plus 12.5% times 0.2 plus 15% times 0.1 gives me 9.6%. This 9.6% is a familiar number. We also got it a couple of slides back. I'll go there so you can double check. Here, half of 17.4 plus half of 1.7 was 9.6, or we look at the portfolio, so I only had to go right back. That's why I couldn't find it so fast. And here, doing portfolios and multiplying by their probabilities, we get the same 9.6. So no surprise there. But now let's calculate the standard deviation or risk of this portfolio. The formula for risk is the probability multiplied by the actual value, which is, go up here, the actual, in a recession, the probability is 0.1. The actual value is 3, minus the average 9.6 and squared. Probability 0.2, the portfolio return of 6.4 minus expected return of 9.6 squared. Probability 0.4, expected return of 10 minus 9.6 squared. Probability 0.2, return of 12.5 for the portfolio minus expected return of 9.6 squared, and finally probability of 0.1 times 15 minus 9.6 squared. Excuse me. And if you take the square root of this variance, you get 3.3%. So what happened here is we got average return, which was half of the return of high times and half of the return of collection agency. But we did not get average risk. The risk of high times was 20% measured by standard deviation. The risk of collection agency was 13.4%. The average risk would be 20 plus 13.4 divided by 2, and that's 16.7%. But we got 3.3% risk. We removed or killed risk. And the idea here is that when we go back to this table, the same elementary idea of not putting all our eggs in one basket happens here. If high times loses us money minus 22% in a recession, collection agency makes us 28%, covers for it. When the economy is booming, collection agency loses 20% of our money, but high time covers for it by making 50% for us. So we always end up making money. So in a sense, the idea of Harry Markowitz is rather simple. It says don't put all your money on stocks of Siemens, but if you purchase Siemens and ThyssenKrupp together and hold these two stocks, sometimes Siemens doesn't make you money and ThyssenKrupp does, and other times ThyssenKrupp doesn't make you money and Siemens does. He says diversify. Here is another easy way of looking at diversification, because a picture talks 1,000 words. Imagine that the stock W moves according to this blue curve that I have, and that's kind of gives us its probability distribution. On the horizontal axis, I have all the events that can happen, and on the vertical axis, I have the percentage return of this stock. Imagine that there is another stock which Brigham and Houston called the stock M, because it's just opposite of W. And we hold these two stocks together. Well, look at this point 0. The stock M loses 10% for you, and at point 0, stock W makes 25%. 25 minus 10 becomes 15. Take another point here. For example, here, a stock W makes you nothing, but a stock M makes you 25. I'm sorry, it's this point, makes you 15. 15 plus 0 is 15. Another point is here, W makes you 25, and corresponds to here, should go a little lower, and M loses you 10. So when we put these two stocks together, we get a sure thing of 15 at every point. These two stocks are, we say they are correlated by a correlation coefficient of -1. And that's something that we saw in statistics. It basically says if two things are independent of each other, like the weather in Siberia and the number of BMWs we sell in Argentina, then this rho or coefficient of correlation would be 0. If two things are perfectly moving against each other, like this W and M, this correlation coefficient in this case is -1. And if they perfectly move up and down together, this correlation coefficient is +1. And that +1 is the only time when we form a portfolio, we will not reduce risk. And that would be this graph. We have a stock M and a stock M prime. And in reality, this only happens if we keep two shares of ThyssenKrupp together. When one share goes up, the other one goes up exactly and proportionally with it. If we put these two shares together and add the two graphs, we basically get the same volatility or the same graph. Now walk Sharp, Linter, and Markowitz in, as in theater, they give us this formula. Ki equals KRF plus Km minus KRF times beta. They're telling us don't use a standard deviation as a measure of risk. Use a new measure which they call beta. And we want to spend some time on this beta. But in World of Finance, we go to our Bloomberg terminal and we look up beta for ThyssenKrupp. We look up beta for Siemens. And it's the measure of riskiness of that stock. Of course, we know how to calculate betas, and I'll go over it in a minute, but usually we don't calculate them ourselves. We get them from data providers. So the security market line says KI. Read KI as how much ThyssenKrupp should return us, should pay us as cost of capital. Cost of capital that ThyssenKrupp pays becomes the return that us investors make. And of course, as this I changes, how much should Siemens make for us, the return on Siemens? Should equal KRF, the risk-free rate. Let's say the return that loaning our money to German government makes, plus Km minus KRF. Because we're subtracting two things from each other, we call this a premium or excess return. How much the stock market or DAX made more than how much the government paid us, the German government paid us on a loan to German government, risk-free rate. Km minus KRF is the risk premium of the stock market, how much the stock market paid more than the risk-free. And multiply that by beta. That right away gives us an interpretation of beta. If beta is 0, this risk premium of a stock market drops out. So Km minus KRF multiplied by 0 becomes 0. So we get the risk-free rate. So the risk, a beta of 0 tells us that the asset has no risk, never loses money. If beta is 1, we get the risk premium for a stock market plus risk premium. And of course, this risk-free rates drop out of the formula, and we just get the return on a stock market. So a stock market or DAX has a beta of 1. Now we get a very beautiful interpretation. If the beta is 2, we are multiplying this Km minus KRF by 2. So we are saying this stock is twice as risky as DAX, and it should pay twice the risk premium that DAX pays or the German stock market pays. And we have an interpretation for negative betas. Remember, negative standard deviation meant that I don't know what I'm talking about, but negative betas exist. They're rare. It means the business is counter-cyclical. The best example of it is that collection agency where they make more money in bad economic times. Sometimes McDonald's is counter-cyclical in US, but not in Germany because prices are higher and the food is more premium here. But in US, when we didn't have money to go to a restaurant, we go to McDonald's, right? Because it's cheaper. So at bad economic times, they made more money, counter-cyclical. Then the game becomes putting numbers into this equation, which is quite easy. If the risk-free is given to you as 8%, DAX is making you 15%, then you say the risk premium for the market, RP sub M, equals KM minus KRF, or 15 minus 8, and equals 7%. This 7% is a factor that goes for every stock this period. And then the rest of it is multiplying this 7% by beta of that stock and adding a risk-free to it. This 7% changes year to year, and we use that to gauge the economic health of a country, where when we are in a recession, these risk premiums change. And risk-free rates also change over time, and that also gives us a look at the fundamental of an economy. How to calculate beta? This is basically a regression. A regression is, of course, something that you guys know from high school and your other classes. A quick review here is for 3 points. In this 3 years, the stock market returned 15% year one, when Siemens returned 18%. Year two, stock market lost 5% and Siemens lost 10%. Year three, the stock market made 12% and Siemens made 16%. We want to calculate beta of Siemens based on these 3 years of data. Of course, in reality, we need much more data, but 3 years of data is the simplest example I can give you for doing regression by hand. The idea is to plot these numbers on the return on Siemens, which is the vertical axis in percentage, KI bar, and the return on the market, KM, which is the horizontal axis. And these 3 points become those 3 dots that I have in black in this slide. Now, the idea of regression is I got to fit a straight line to this data that is the best straight line. Well, if I want a computer to do this, I have to define what I mean by the best. Well, I say the distance of these points from the line has to be minimum. We can eyeball this and have a straight ruler there and move it around, or a piece of straight wood, and by our eye seeing when it's closest to this point, or we can define distance as dropping a perpendicular from the point to the line. That would be a natural way to define distance in math, but it would give us a different, more difficult regression. In normal regression, you look at y of each point, and you go vertically up, and you look at this distance. This is an error. And the point, if that's my line, the point is this much under the line, so this is a negative distance. Here, the point is that much over the line, and that's a positive distance, and this point has 0 error. Now, if I just sum up the errors in order to minimize them, the negative errors and the positive errors cancel each other, and I call this deviation from mean, and we go back to our old trick. We square the deviations, and then we add them up. So usually your computer program spits this out as SSE, sum of square errors. And sum of square errors is nothing but the distance of each one of these points, the y's, added up, first squared and then added up. And when in your printout you see SSE, the smaller it is, the better. So we want to minimize that thing. Okay, to actually minimize this thing, I wrote my x's, I wrote my y's in this slide. I look at the difference or deviation from the average for each x, deviation from average for each y, multiply these two together, and then I squared the deviations from average for x's and added those up. So the formula for my beta became dividing by this summation I equal 1 to n xi minus x bar squared. That thing is nothing but the variance, except it's not divided by n minus 1. And what appears upstairs, summation xi minus x bar times yi minus y bar is covariance. And it's divided by n minus 1, the two n minus 1s cancel. So the formula for beta becomes covariance divided by variance of x's, covariance of x and y. And then the formula for alpha is also written there. It's basically the average of y's minus beta times average of x's. Alpha turns to be something that we use for measuring how well the money managers do. Because if you look at the line, where the line hits the vertical axis, then alpha is 0. I'm sorry, Km is 0. When at point alpha, the line hits the vertical axis. So this becomes quite meaningful for a money manager. We are saying how much this money manager makes us when DAX makes us no money. In this case, the money manager loses us money. But if you have a money manager that has a positive alpha, this is a good money manager, makes us money when DAX doesn't make us money. Okay, we talked about how to interpret betas. Most betas we see in Germany are something between 0.5 and 1.5. It's very rare to see a number outside of that range. And the rest of it we talked about. So from now on, we are going to evaluate investments based on their beta, something that the data provider would give us, comes from our Bloomberg terminal. And in this classroom exercise, beta of high times is 1.3. Beta of treasury bills with no risk is 0. Beta of collection agency is negative because they are counter-cyclical, and it's minus 0.87. And we go to interpreting risk and return based on risk measured by beta, which is something that we do in finance all the time. We don't look at the standard deviations as a measure of risk. That's for the past data, when we have the data. For estimating the riskiness of a future investment in the stocks or anything else, we use beta to measure that riskiness. Okay, now we have a table in front of us that we want to evaluate. Is there an investment here that dominates another investment? Remember that concept of dominance? The CFA asked us that too, about dominance. And it's an investment that makes us more money and has less risk than the other investment. Now it's time to pause and see what you guys think. Is there an investment that dominates another investment? Notice that treasury bills do not dominate collection agency. Treasury bills make 8%. They have a risk of 0, but collection agency have a negative risk measured by beta.
Could you say that the USR is dominating the market if you put it relative to the beta? So 13.8 to 0.89 is like around 16, and
The
15.
Russian investment makes less money than the German market, than DAX. DAX makes 15%. Russian investment gives us 13.8. But it has less risk too. DAX has a risk of 1.0, but Russian investment has a risk of 0.89. So it's not dominated. At less risk, it makes us less return. How about comparing it to treasury bills? It's still not dominated, right? Another way of looking at this is to look at the risk. The risks are pretty much ordered here, going from minus 0.87, going higher to 0, going to 0.89, going to 1, going to 1.3. And the expected returns are also ordered, going from 1.7 to 8 to 13.8 to 15 to 17.4. So every investment that has more risk is giving us more money. Nothing is dominated here. So previously we had an investment that was dominated, and that was because our measure of risk was wrong. We didn't look at the fact that this collection agency could help us reduce risk, that it has a negative beta. Another way of putting that is to say riskier securities have higher returns, so the rank order is okay, nothing dominates anything else. Okay, now we are going to calculate expected return, and that's what CAPM formula does for us. It says what's a fair amount, or what is a return that is commensurate or in line with the riskiness of an asset. And for that, we say that every investment should fit in the CAPM formula. So for high times, CAPM formula always stays the same, 8% risk-free, 15 for the DAX minus 8, that's always 7%. The only thing that is different is beta of high times, which is 1.3. And if we calculate these numbers, high times should pay us 17.1. That's what they should pay, but in reality, we calculate an expected return for them that was different. We compare this with the expected return, and if expected return is more than 17.1, we say that's a good investment. It pays us more than it should. If it pays us less than 17.1, we give a sell order. We say this is an investment that makes us less money than it should, justified by its risk. So let's do this for each one of these investments and take it to a graph here. This graph is a little bit different. On the horizontal axis, it has the risk of each investment measured by beta of 0, 1, and 2. And as I said before, usually the numbers are far under 2 for most of the stocks. And then the vertical axis is return on each stock. On this beta and KI, or risk and return graph, we have the security market line. One way of drawing the security market line is to say that risk-free rate and the stock market DAX are always on the security market line. The formula security market line is KI equal 8% here plus 7% times beta, and the risk-free has a beta of 0, so the point 8% risk-free and 0 risk, that blue point here treasury bills is always on the line, and the stock market would have a beta of 1, and that would be 8 plus 7 equals 15%. So this 15 and 1 is always on the line. We calculate these 2 points and connect them to each other, and we got our security market line. Every investment on this line is paying us what we expected to pay. It's a fair investment. We give a hold order. If you have it, don't sell this stock. It's not worth transaction costs. If you don't have it, don't buy it. The Russian investment falls under the line, and we say it's a bad investment. Don't tell the Russians about that. That's just a joke, right? And finance jokes don't get any better than this. The high times is above the line, so we say it's a good investment. And collection agency is under the line, so its risk is not justified by its return. So we use this beta as a measure of risk, and the security market line or the CAPM formula as a way to pick stocks. And of course, the devil is in the details, and quite a few things that go into this equation involve assumptions that may not quite be valid. And we look at those assumptions in a minute. The first thing, the first assumption that would bother us is that this is a one-factor model. We are essentially saying that how much money Siemens makes for us depends on DAX, or riskiness of the stock market, and the risk premium that the stock market pays. There are other factors that affect the value of the stock or how much money it makes for us. So there was a search for multi-factor models beside CAPM. None of them became quite popular. None of them won a Nobel Prize for someone. But there is one that is in the literature, and CFA would ask us about it, a multi-factor model. And empirical studies in finance show that this model is quite accurate. However, in reality, it's not as user-friendly or as workable, so money managers don't use it that much. And maybe that's why it didn't win a Nobel Prize for anyone. We'll talk about it in a minute. Here are the assumptions of CAPM. CFA would ask us about these assumptions. And the first assumption, which is quite obnoxious, says that investors look at expected return or mean return of investments and look at the variance and beta of these investments. This may not be how rational people and on aggregate investors in a society decide on value of stocks. The other assumption that goes into this model and is required for various proofs that we have later on is that lending and borrowing rates are the same. They are not. When you and I go to borrow money to buy a home, for example, they may give us 4%. And when we put our money in a bank, which we essentially loan it, they give us next to nothing. Of course, our risk is very different from the risk of the bank, but even after adjusting for that, lending and borrowing rates are not the same. Next one is called homogeneous expectations. These words are not telling us exactly what this thing means, so I wrote a sentence next to it. It says all investors hold the same beliefs about future assets returns and variances and covariances. If we don't agree about these calculations, then we would have different preferences. The other assumption is that we have a one-period model now, which is usually time 0, and time 1, next period, when we cash our investment. We have multi-period models, but they get more difficult. And the other required assumption that CFA would throw at us in the exams is divisible assets. It basically means I can divide this asset by 2. I can divide this asset in 100 pieces. Think of a house. I can't divide that asset in 100 pieces. Frictionless markets means we don't pay commissions and we don't lose money to do trade. No inflation, and inflation would change these models. There are models that consider inflation. And I did a little example that considered inflation in a very elementary way. And then finally, we are assuming that these markets are in equilibrium and the prices are not fluctuating out of economic equilibrium. With all that said, let's take us to a different model that is in the literature and CFA would ask us about it, and that's called arbitrage pricing theory. It's basically multi-factor. It says that there are premiums for several different factors, not just for DAX or the stock market of a country. So it becomes a multi-factor regression. And then the question is, what are these factors? There were many empirical studies in finance, and the following factors are proposed. Of course, the first factor or risk premium is the stock market itself, but interest rates are a factor, yield spreads are a factor, exchange rates are a factor, gross national product of the country is a factor, inflation is a factor, and finally the stock market, as I mentioned it before. Those come in empirical research. What we should know about this arbitrage pricing theory is that there are multi-factors, and this is a richer model than single factor, and perhaps some of these factors that come in the research and show up. Besides that, we don't get examples or calculations based on this multi-factor model. I have more slides, definitions, and calculations. Some of it are the repeat of what I've said so far. Let me close this, stop sharing, and see if you guys have questions, comments, because so far I couldn't see the screen. First, let's look at comments. So chat, I have nothing on the chat. Questions from the audience on internet or in the classroom? Have a wonderful day, and I'll leave it at that. See you guys next week for a sample mock exam of CFA on this material. And as you know, that's pass and fail, low stress, but we want to be familiar with these questions. And then I share with you all the questions I have. See you then.
Professor, I have a request.
Sure.
I know that you post the recording of this lecture on Ilyas of Uni Tübingen. Could you share with us the password for it?
Oh, last time it had a password?
Yes.
Oops. Okay. Usually this record says that if you follow it, it doesn't need a password, but they have some error there. I'll give you the password for sure. Sorry about that.
Thank you,
Oh,
Professor.
something else. The recording is also on YouTube, and YouTube has no password. And I shared with you that link to YouTube also. So both are the same. But I would gladly share you the password that this WebEx has. Goodbye. Other questions, comments? See you guys next week. Bye-bye.